As I've said before, we have to eliminate for all intra-group transactions within the group. So the consolidation process includes procedures that eliminate all effects of the intra-group transaction. So no matter the parent is selling something to the subsidiary is selling something to the parent, or one subsidiary is selling something to another subsidiary, we have to eliminate. This applies to inventory, property, plant, and equipment, any kind of services, actually any kind of financing, also we have to eliminate, because we treat the group as one single economic entity. So if we treat the group as one single economic entity, then any transaction within the group, say for example from parent to subsidiary, from subsidiary to parent, or even from one subsidiary to another subsidiary, is not a transaction with outside party. If it is not a transaction with outside party, we should not regard it as a valid transaction. It's just like a transfer between the departments within one single economic entity. So if this is just a transaction between departments, we will not say that this is a sales. So therefore, we will eliminate all transactions within a group. So remember, a group includes only parent and subsidiary. So we eliminate everything between and among parent and subsidiary. So we will recognize those sales, etc. if we really have got a transaction with outside party. So if we purchase something from the outside party, if we sell something to the outside party, we will regard it as a valid sales, valid purchase. But any transaction within the group is not. So transfer of assets within the group usually will include a profit margin. This margin is regarded as unrealized until we really have a transaction with outside party. If this is just a transaction within the party, we say that the risk and reward of ownership of the asset remain within the group, and therefore the profit is unrealized until we really sell it to a third party. So, take an example. If we purchase something by company A, and then company A sells something to company B, so of course the purchase of company A will be recorded, but any sales to company B will not be recorded on consolidation. In the individual financial statements, of course A will record, but on consolidation, we will not record this intra-group transaction. Therefore, there will be a consolidation adjustment, eliminate this sales by company A to company B. This is what we are going to do. So consolidation is required so that only transaction with external parties, with outside party, will be reflected in the consolidated amounts. Take a simple example for services. Say for example, in this case, there is a transaction relating to interest. So maybe company A is a parent, company B is a subsidiary. So company A being a parent, they provide some kind of finance to company B and they charge company B interest. So in the financial statement of company A, they have got interest income. In the financial statement of company B, they will have interest expense. This is 100% correct in the financial statement of company A and in the financial statement of company B. However, on consolidation, we treat company A and company B, being the parent and subsidiary, as if they are one single economic entity. Therefore, any transaction within the group should not be regarded as a valid transaction. This is just like one transaction from one department to another department. Therefore, on consolidation, we have to eliminate this interest income and interest expense. To eliminate means we have to debit away this interest income. We have to credit away this interest expense. So we debit away the interest income and credit away the interest expense. This applies not only to interest, this applies also to other kind of services like service income, rental income, etc. So in the financial statement of the parent, they may have charged the company B some service income or rental income. This is correct in the company's own financial statement. And also for company B, being a subsidiary, they may have paid service expense, rental expense, etc. This is also correct. But on consolidation, we treat this company A and company B as if this is one single economic entity. Therefore, any transaction within the group should be eliminated. So therefore, on consolidation, we will debit away this service income. We will credit away the service expense. If there exists rental income, we debit away the rental income and credit away the rental expense. Actually, we eliminate also for the dividend. Remember, we say that any dividend income, dividend decay between the parent and subsidiary should be eliminated. So the parent may have recognized the dividend income, the subsidiary may have declared the dividend pay. So in the individual financial statement, this is correct. But on consolidation, we need to debit away this dividend income. We need to credit away this dividend decay. So we eliminated this dividend income and dividend decay. So if the dividend has not been paid, so in the parent's own book, they may have a dividend receivable. If it is not yet paid in the company's B's own financial statement, there will be a dividend payable. So we have to eliminate not only intra-group transaction, but also intra-group balance. So therefore, on consolidation, we will credit away this dividend receivable and we will debit away this dividend payable. So we credit away the dividend receivable, we debit away the dividend payable. For the interest and service provided, if it has not been paid, also there will be a debit to the interest receivable and a credit to the interest payable here. If we do have a interest receivable, interest payable, we have to eliminate also this interest receivable and interest payable. But if it has been paid, we don't really credit away bank and debit away bank, right? So if it has not been paid, we eliminate the receivable and payable. If it has been paid, we just leave it, the debit and the credit to the bank, right? Because the ultimate effect is zero.